Hello, and welcome to the latest Insights Live Real Estate in Your Money. I'm Susie Allen, Vice President of Insights from Fidelity Wealth Management. Thank you for joining us and submitting questions to help form our discussion. Now, here at Fidelity, we help clients plan for an array of financial needs, and real estate touches so many of them. Since for many of us, our homes are not just a place to live, they're the largest asset we own. Today, we're going to discuss the housing market, financing, taxes, passing real estate to heirs, and more. And later, we'll also take some live questions from you, our viewers. Today, I'm joined by Danielle Plum, a wealth planner in Colorado, and Mike Mariani, a vice president on the Lending Solutions team. Now, before we get going, I need to let you know that Fidelity does not give tax or legal advice, and nothing we discuss today should be interpreted as tax or legal advice. The information we are providing is going to be general in nature, and it may not apply to your situation. If you have legal or tax questions about your specific situation, we encourage you to talk to your attorney or tax professional. Now let's get started. And let's start with a somewhat provocative question. For several years now, overall home ownership rates in the US have been falling, and we've heard that younger people are questioning whether real estate is an essential part of building wealth. So, Danielle, first, welcome back. And as a wealth planner, what's your view on this?
Thanks, Susie. Happy to be here. Homeownership has been the traditional American dream. With most of my clients, other than their 401k, their home is often the largest component of their net worth. But you're right, that the home ownership rate for Gen Z, people born between 1997 and 2012, is just 16%. And the share of first-time home buyers is at an all-time low. I've actually had clients want to help their kids get into a home, and the kids have declined. There's also been a six-fold increase in the number of young people investing in the stock market over the past decade. This suggests a shift in the way they think about building wealth. Some experts have actually revisited the view that real estate is always an essential to building wealth, though many still view it as an important component depending on your goals, your risk tolerance, and time horizon. As a wealth planner, my view is that paying a monthly mortgage can still be a great strategy for building wealth. One reason for that is that you cannot skip a mortgage payment in the way that you can skip adding money to your investments. The two different approaches to building wealth can also have different emotional impacts in that building wealth in your home, you don't really have that transparency in the daily value of your home. While investing in markets, you can see the growth and even the declines on a daily basis. And this can really influence how people feel about adding more assets to their money.
Well, Danielle, your answer hints at a number of issues such as affordability, mortgages, and the housing market that we're going to dig into during this webinar. So, Mike, welcome back. And last year, if you recall, you came on the show and talked about the general slowness of the market. And at the time, you saw potential for it to swing back to a buyer's market. So, has anything changed in your outlook since then?
Yeah, thanks, Susie, and great to be back with you. And there have been some meaningful developments since we last spoke. Over the past year, we have started to see a shift now in the housing market, one that increasingly favors buyers in many parts of the country. And there's really two major forces that we're seeing driving this transition. You have housing affordability and then the rising for sale inventory. So last year, existing home sales fell to a new 30-year low, and housing affordability continues to be strained. So buyers are really contending with higher mortgage rates, elevated home prices, and then you have increased insurance and tax costs that really come along with property ownership. So that's all going to add up to how much house a person can afford. As a result, the pool of active buyers has thinned out. And in many markets, there are now more sellers than buyers, which is helping inventory climb and then tilting the leverage towards purchasers. I often think of today's real estate dynamics through a pre-2020 versus a post-2020 lens, because so much of the market's foundation is shifted during that period. Coming out of 2020, inventory was exceptionally low and demand was high almost everywhere, which fueled that rapid home price appreciation that we all remember. Since then, the market has really split along two different distinct paths. In some regions, particularly faster growing cities, they were able to expand new construction, which helped to increase their overall inventory of housing supply. Well, others were constrained, whether it's by land availability or zoning or permitting challenges, and that prevented supply from keeping pace with the demand.
Well, as they say, all real estate is local, and you touched upon this a little. We have clients watching this from all over the country. Welcome. Could you give us a little regional perspective?
Sure, we could take a look at an example. So the chart we're looking at compared the national inventory levels with two major metros. You have Dallas and Chicago. Now, each one took a different trajectory that I was just talking about. If we look at Dallas, in the housing inventory in Q4, and we're comparing it to the years leading up to 2020 that I mentioned, it's actually 36% above where they were prior to then. But if we look at Chicago, that inventory compared to that time period is 56% below where it was prior to 2020. So from a buyer's perspective, this is going to show up most visibly in pricing. And then on the right side, if we're comparing the prices, so Dallas, the home prices had fallen by about 2% year over year, and that's thanks to that higher housing supply. But Chicago, with the limited supply, is still seeing prices rise about 6% year over year. And then compared to the national number, where prices are growing at roughly 1%, it just demonstrates just how wide this regional divergence has become. Now, more broadly speaking, when we look at markets primarily in the Northeast and Midwest, those markets tend to resemble that Chicago pattern. So we have tighter housing supply and continued price appreciation. But if we compare it to some of the markets in the South and the Sun Belt states, those are more closely following Dallas. So you have higher inventory, which is good. There's more options for buyers and greater flexibility for them on prices and terms and incentives. So I guess what does that all mean for today's buyers, right? In markets with increased supply, the buyers now have more choices, more negotiating power. And depending on where you are in the country, housing supply may finally be advantageous for new buyers. And that's something we really haven't been able to say for quite some time.
Thank you, Mike. I'm going to ask you another question here. So after several years of rising interest rates, home buyers finally saw a tiny bit of relief last year after the Federal Reserve cut interest rates. But still, mortgage rates are a lot higher than many of us remember from before 2020. So when, if ever, might we see mortgage rates below 6% again?
Yeah, Susie. So rates have come down a little bit over the past year, but they're still sitting right around that 6% level. Really, since 2022, we've seen mortgage rates stay pretty consistently in a 6 to 7% range. And that is a big shift from before when there was a 3.8% average in the decade leading up to it. On a $400,000 loan as an example here, that increase in payment works out to be about $660 per month. So pretty meaningful. Now, the Fed has lowered rates, the Fed funds rate, by 1.75% since 2024. And that's helped to bring down rates on things like HELOCs. So those moved from right around 8.5% down to closer to 7% today. But mortgage rates don't follow the Fed funds rate directly. They tend to move with longer term rates, especially the 10-year Treasury, and they're mainly influenced by expectations for economic growth and inflation. Inflation has improved, though down from those really elevated levels we saw really in 2022 and 23, but it's still sitting in a 2 to 3% zone, which is above the Fed's long-term target. And that's a big reason here why mortgage rates haven't fallen more dramatically. In terms of long-term expectation for rates going lower, the average, when we look back over the past 30 years for mortgage rates, has been 5.5%. So actually not too far off from where we are today at current rates. I personally think it's reasonable to look at that level for the benchmark, and I think less about the sub 3% levels that materialized in 2021. If we were to see a slowdown in economic activity, and that could be driven by rising unemployment, or if we saw inflation falling below that 2% level that the Fed looks for, then it becomes more likely that mortgage rates could consistently return to levels below 6%.
Thank you for that analysis. We are definitely seeing that higher interest rates have impacted housing affordability, which has been an issue, especially for younger buyers. So, an option. So, parents who may be interested in helping their child finance a home, what are some of those considerations? Danielle, hoping you can help us there.
Yeah, Susie, this comes up a lot with clients. They often wonder if giving kids money now could be more useful than an inheritance later in life. So I'll walk through some common scenarios that I work with clients on. One is to help with the down payment. This is a good way to supplement a child's savings, but the majority of the commitment is still on the child. The child will be building their credit, so that's good for them. The higher down payment might help them be more successful in some of these competitive markets. And it could maybe even help them get a lower mortgage rate and avoid private mortgage insurance. Some things that you want to consider when you're gifting money to a child is that we have to stay within the annual gifting limits or report to the IRS. So the annual amount you do not have to report to the IRS is $19,000 a year. For a married couple, it'd be $38,000, or you have to report it. If you report it, it just reduces the lifetime gift amount, which is 15 million, 30 million per couple.
Danielle, I just want to pop in and ask you, taxes, tax season. So besides estate taxes, are there other tax implications for parents who gift a down payment?
Yes, absolutely. You need to think about where the funds are coming from to give the kid the down payment, right? So for example, if they're coming from an IRA, it's going to count as taxable income and it's going to be taxed at the client's ordinary income rate. So you're thinking about the tax brackets of 12, 22, 24, 32, 35, and that can be a substantial amount of how much, additional amount of how much you need to take out to account for the count taxes as well. If the funds are coming from like a non-IRA account and they're invested, you would have to pay capital gains at either the 15 or 20% rate, assuming that the asset has been held for more than 1 year. With both of these scenarios, it's important to also consider that if you increase your income levels to certain places, your Medicare premiums can go up. So for this year, the amount is 109 for a single filer, 218,000 for a married filer. And then, but we can be creative sometimes. So I've had some scenarios where a child is in the 0% capital gains bracket. Maybe they've just gotten out of college and haven't gotten their first job yet, for example. And in this scenario, we can gift appreciated assets and then help the child sell them, where they would pay 0% taxes, which can be a substantial difference depending on the client situation.
Oh, definitely a big difference. Well, thank you for clearing that up. Just to continue on your thought there. So what are some of the other strategies for helping a child?
Yeah, so some of my clients have wanted to just loan the funds to a child, essentially be in the bank for the kid. So the potential way, a good way to deploy cash is while this could be a good way to, deploy some of your cash while giving the child access to maybe a lower mortgage rate than what they would pay if they went the conventional route. I talked a little bit earlier sometimes about a larger down payment, but also a cash buyer could sometimes be more competitive in a tight market. So things you want to consider here would be that you want to make sure you're comfortable with the child's finances. Think about how you would deal with maybe a potential late or missed payment. You do need to understand this doesn't help the child build their own credit because it wouldn't be reported to the credit agencies. And you need to think about the IRS guidelines because the IRS does specify a minimum rate based on current interest rates that you need to give the loan to a child for. The loan also has to be set up as a promissory note with payment terms, or it can be considered a gift. So another way that I've seen clients help kids is to just buy a home and be the landlord for a child. So this can also be a great way to help out, a child. And I used this with a client in a scenario where they had multiple children, and a couple of them were financially independent and didn't need help. So they thought this was a better option. It can generate a somewhat passive income stream for the client from the rental income. So you need to think about things. For example, make sure you're charging market rent, or it can be considered a gift. You need to think about, all of the expenses for upkeep, repairs, insurance, taxes, And you're also going to have to report the rental income on your taxes. So you have to think about how that could impact your overall tax situation. Later, if you decided to gift the house to the child and the house had appreciated substantially, you'd have to report the difference between the sell price and the fair market value as a gift. This would reduce your lifetime gift amount, which currently is 15 million per person, so 30 million for a couple.
Well, I definitely feel like the landlord to my children sometimes, but joking aside, those are really good considerations. All right. Well, another group strongly impacted by housing affordability is retirees. And for your retired clients, Danielle, who may be looking into relocating or downsizing, what are some of the considerations you discuss?
Yes, I frequently walk through this with clients. As retirees find themselves in the big family home without the family, they often wonder if they want to downsize. So a client that I recently walked through this scenario with, wanted to get out of the 3-story house and maybe go to a smaller home or a planned community that had less landscaping, for example. And when they evaluated, they realized they were actually going to pay more money when they factored in the cost of the property and the homeowner fees. So they kind of took a step back and realized they really liked the current neighborhood that they lived in. So they decided to just invest the money into upgrades to make the home easier to age in, place in. And they hired a service for yard work and snow removal and some of the home maintenance. So that worked out for them, but other clients that I have worked with have made the decision to go ahead and downsize. So with these types of scenarios, I think we always want to just take a step back and evaluate the financial costs of the move. So there's moving expenses, you maybe are moving to a different area that has different tax considerations, maybe insurance considerations. And so we just want to, kind of map it all out and make sure that the new costs are still supported by their overall assets and financial plan. And, I think, Susie, one of the biggest challenges for relocating or downsizing for my clients is how to time the sale of the current home to pay for the new home.
Yeah, timing, buying and selling is certainly tricky. And I think Mike can help us here. So if someone is trying to buy and sell at the same time, what are their financing options?
Right. And we talked before about interest rates and how they're still sitting around 6% above that long-term average. So a lot of clients are asking about alternative ways to buy a home without immediately locking into a traditional 30-year mortgage. And there are actually several strategies that can help bridge that gap between buying the new home and then selling your existing one. Ideally, you could time it so that you could buy and sell at the same time. So a lot of people do have equity built up in their home, and you could use those sales proceeds from the current home to support the purchase of the next one all on the same day. That's ideal, but the timing doesn't always line up perfectly in real life. Another approach here would be to sell first and then negotiate what's called a leaseback. In that scenario, you sell your home, but you stay in it for an agreed upon period while paying rent to the new owners. This lets you access your equity right away, so giving you the cash you need to shop for that new home, while still giving you some time to find that right place. A third strategy that we're seeing more and more people use is that clients will explore using a securities-based line of credit or a margin loan as a temporary bridge for this scenario. So these would allow you to borrow against your assets in non-retirement investment accounts without having to sell those investments immediately. For buyers who want or need to purchase first, this can be really helpful. It's going to keep your portfolio intact, avoid triggering capital gains right away, and would still position you to make a competitive offer as a cash buyer in the market. That said, it's really important here to understand the details. So you want to understand how the interest payments work, what happens if markets move, and what risks come along with borrowing against your invested assets. If you do choose to use this buy first, sell later strategy with the securities-based loan, the sale of your existing home could then be used to pay down or pay off the balance once the sale closes. And then another option here to further think about after the closing is that you could transition some or all of the balance from that line of credit into a more traditional mortgage structure that potentially can have tax advantages. If that's the path you're considering, it's important to talk with the lender ahead of time to make sure that they can support the transaction and then to really understand any rate or timing considerations that might come into play.
Well, the securities-backed line of credit is an interesting option for clients who have significant assets in a brokerage account. But what if most of your assets are in an IRA?
For clients whose assets are primarily inside retirement accounts, it does get more challenging here because securities-based lines of credit aren't available on IRAs or other qualified retirement accounts. One workaround people sometimes ask about is the IRS rule that allows a once per year 60-day IRA distribution. This lets someone takes their funds out of an IRA and then put the same amount back within 60 days without taxes or a penalty. However, here it's going to be important to approach this really carefully. There are a few considerations that I'd like to highlight here. It can only be done once every 12 months, and that limit applies across all of your IRAs combined. And there is a hard 60-day deadline. So if you miss that window, even by one day, it results in the distribution becoming fully taxable. And additionally, if you're under 59 and a half, it can also trigger a 10% early withdrawal penalty. And additionally, you want to consider the amount taken out here is completely out of the market during that 60-day period, which could work for or against you depending on the market movement.
Thank you for going over those rules. Certainly good things to consider. Well, let's swing back to a retirement-related question we hear often. Should you try to pay off your mortgage early or at least before retirement? Danielle, help us here.
Yes, Susie, it used to be a very common goal for clients to pay off their mortgage before retirement. Since your mortgage is often your largest expense, it can feel just very comfortable to not have this payment. I do think, though, as some clients were able to refinance to record low rates, sometimes I saw rates as low as 2.5% in financial plans. They started to view this differently, and some of them would rather carry the mortgage and put more funds into their investments accounts that could have some potential to earn a higher rate than they are paying. So I think at the end of the day, there's not a right or wrong answer here. Emotionally, it can feel good to not have a mortgage. But as long as you have the assets and the financial plan to generate the monthly income to make the mortgage payment, it's fine to still have one when you move into retirement.
All right. Well, on the flip side, for retirees buying a home, Mike, is it still possible to qualify for a mortgage when you no longer have active income?
This is a really common question I hear. If I'm retired or getting close to that retirement age and I want to buy a home or refinance an existing mortgage, can I still qualify without the steady paycheck income? And the good news is yes, many retirees can still qualify. Lenders don't just look for W-2 income, they want to look at your entire financial picture. That can include things like pension income, Social Security, IRA distributions, even annuity payments. And all of these count as income sources when a lender is assessing your ability to repay that loan. On top of that, many lenders will also consider your total assets, so your bank accounts and your investment portfolio, through what's called asset-based income. Instead of just relying on paycheck income, the lenders can essentially convert your assets into an equivalent monthly income amount. So this can be really helpful for people who may not have traditional wages, but do have significant savings or investment accounts. And retirees and self-employed borrowers, I often think, fit into this category. And this is why I always recommend having a quick conversation with the mortgage lender early in your process. They can walk through different qualifying paths like asset-derived income that may be available to you. And it's going to ensure you get a full picture of what's possible before making any decisions.
Mike, just a follow-up. I always tell my clients after they talk to their mortgage lender to call me, because we can often set up like a monthly distribution, for example, to show income and generate a letter for the lender. So it's really just bringing your resources together in a partnership to help you get through these more complex and difficult situations.
Thank you both. Let's broaden this to a question for anyone who might be financing a purchase. So especially with rates still relatively high, Danielle, how do you address this question with clients who ask, get a mortgage or pay in cash?
Yeah, as we've talked about a little bit today, a cash offer could make you more competitive if you're in a tight housing market. It might cut some costs as well. So here's some things that you might want to consider. The first is think about the opportunity cost. So how are the funds you're going to use currently invested? If they're in your cash account, for example, the interest rate that you would be paying on a mortgage might be higher than you're currently earning. So might be a good place to use the cash. It is possible, though, that you could be earning more than your mortgage rate in your investments and maybe wouldn't want to liquidate those. So you always want to think about the opportunity cost of those funds. The second is liquidity. A home is somewhat less liquid than investments. So there's ways to tap into the equity of your home, but it's not as liquid as an investment or cash account. So you want to think about the additional costs you sometimes incur moving into a new home, as well as what other expenses you have come up, and still make sure you have a plan for emergencies. The third thing to consider is taxes. Earlier, I discussed the different taxes that you will incur depending on the type of account where you withdraw the funds from, as well as how much you might end up paying for Medicare in some situations. But you also want to consider your tax deduction strategy to determine if you'd be itemizing or take it as standard deduction. Sometimes itemizing can offset some of the costs of the loan, but typically not all of it. So, I think finally you can be strategic with your mortgage lender. As Mike discussed earlier, you can try to optimize your strategy with your lender. So, run through some scenarios. Maybe a higher down payment would lower your interest rate. Perhaps a shorter loan term would get you a better rate. So it's really just kind of playing through the scenarios, thinking about everything involved, and then making the best decision after you have all of the information.
Thank you, Danielle. Swinging it back to financing, Mike, what do clients need to know about second home financing?
Yeah, if you're thinking about purchasing that second home and you've gone through the decisions that Danielle just outlined in terms of financing it rather than paying cash, it's important to know that the lending rules are going to be a little bit different. Most lenders will require a larger down payment on a second home or an investment property than they would if you were buying your primary residence. And you should also expect a higher interest rate since lenders tend to view second homes as a higher risk loan category. To qualify the property specifically as a vacation home, lenders generally want to see that it's used primarily for your own personal occupancy. Many lenders will allow some short-term rentals throughout the year, but the property can't function like a full-time investment rental if you want to classify it as a second home. That can give you some flexibility, though. You can enjoy the home as a getaway while still potentially generating a bit of rental income during the times you aren't using it. Overall, financing a second home, definitely doable. The key is making sure your intended use of the property lines up with how lenders classify it, and then working with your tax and real estate professionals to understand how those lending rules apply to your own specific situation.
Mike, we've covered buying, so now let's turn to selling. Can you talk about the tax implications of selling your home?
Sure. When you sell your primary home, you may be eligible for a valuable tax benefit, which is available to homeowners, capital gains tax exclusion. Individuals can exclude up to $250,000 of capital gains from taxable income, and married couples filing jointly can exclude up to $500,000. It's important to understand that this exclusion applies only to your primary residence. Vacation homes and investment properties won't qualify. So if you're selling one of these property types, you may face capital gains taxes when you do sell. To qualify for the primary residence exclusion, though, the IRS is going to look for two things. First, there is an ownership test. That simply means you must have owned the home for at least 2 years before you sell it. And then second, there's a use test. This one says you need to have actually lived in the home as your primary residence for at least 2 out of the last 5 years. So as long as you've both owned it and lived in it for a total of 2 years within that 5-year window, you can typically qualify for the exclusion. If not, it's worth planning ahead or speaking with a tax professional to understand what options you may have.
Thanks, Mike. So earlier we talked about second homes and the possibility of using it as rental property. If someone buys a second home and rents it out part or all of the time, what do they need to know about the tax implications there?
For rental properties, you can deduct items such as mortgage interest, property taxes, repairs, maintenance, insurance, utilities, and some depreciation. With your mortgage interest on a second home, the SALT tax, the state and local tax deduction, is going to be $40,000 again for this year. It goes back to $10,000 after 2029. It also phases out starting at 500,000 modified adjusted gross income. So you may be able to deduct the interest on your home, on your taxes as well, or on your rental as well. You do need to think about the fact that this considers all deductions though. So you need to think about your primary home in this calculation as well. When you sell your property at a profit, unlike the primary home, a rental property, you are going to have to pay capital gains taxes on the appreciation. You would have to make it your primary home for 2 years to sell, 2 years before you sell to qualify for the $250,000 exclusion, 500,000 married. Otherwise, you are going to pay the capital gains taxes on it.
All right. Well, we also talked about capital gains taxes on home sales. So for an investment property, is there a strategy to manage that, Mike?
Capital gains taxes can be a pretty major consideration when an investor decides to sell a property, especially after the home price appreciation that we've seen in recent years. One strategy investors will often consider to help manage the tax impact is what's called a 1031 exchange. A 1031 exchange is basically a way for real estate investors to sell one investment property and roll the proceeds into another similar property type while deferring the capital gains taxes that would normally have come due at the time of sale. So you're not avoiding the tax forever, but you are postponing it, which means you can keep more of your money working for you and potentially move into a higher value or a higher income generating property. There are just two big timing rules to keep in mind. First, you have 45 days from the day you sell your property to identify your potential replacement properties. So planning ahead is key. And then second, you have 180 days from the sale to actually close on that new property. Because of these requirements, it's important here to remember a 1031 exchange is pretty complex. You'll need to work with a qualified intermediary, and it's important to consult a tax professional to fully understand the implications and really to make sure that the strategy aligns with your longer term plans. But if it's executed correctly, the 1031 can be a pretty powerful tool for growing a real estate portfolio, deferring taxes, and then potentially compounding that investment potential over time.
Mike, I love that you're talking about this option. I have used this strategy of 1031 with several clients who've had rental properties, maybe business real estate, and they've used the 1031 to invest the funds in a real estate-like investment. So this helped them defer the capital gains, turn the investment into a true passive income stream, and potentially even into an investment that can be passed to the next generation tax-free because of the stepped-up basis of death.
Danielle, you mentioned next generation. So, relatedly, instead of selling, some clients may want to pass real estate on to their children. So let's start with their primary home. How can you pass a home to a beneficiary?
Yes, everybody is thinking about this. So most states do allow you to execute what's called a transfer on death deed. This allows you to maintain full control of the home and the right to change the beneficiary during life, but the home will pass without going through probate. And this is an option that can be executed without an attorney. Another option is to set up a revocable living trust and put the home in the trust. Don't miss that step. A lot of people forget that part. It allows the assets to pass without going through probate. It also requires attorney to set up and change. So it's often used more frequently if you have complexity in your overall finances, but it can simplify things. For example, if you have homes in multiple states. The final option is a will. This is probably a little bit less preferred by some people because it does have to go through probate. It is public record. So it can delay beneficiaries being able to sell the home, and it does have probate costs as well.
Thanks, Danielle. And let's talk a little bit more about second homes. So many of our clients are interested in keeping a vacation home as a family property. So what are some of the considerations around that decision?
Yeah, family homes come with a lot of memories, and so I think people automatically assume that the next generation would want them. But I think it's important to make sure that there is an heir that wants the home and has the means to pay the ongoing costs, such as the maintenance and insurance and taxes. The decision can be more complex too if there's multiple potential beneficiaries and how they would all work together. So some technical ways to pass the home would be you can own a child as a joint owner. This comes with some risks. For example, if the owner goes through a divorce, it could become subject to division. Also at death, the property would only get 50% of the step up on the owner's death. So adding a child, you want to make sure it's the right decision. It also could be considered a gift. So you do have to think about those gifting rules again. A trust can be a really good option here because it would, again, allow the property to pass without going through probate. One really good benefit of a trust is that it organizes everything for the successor trustee. It's all mapped out in the trust. It can also allow you to set some terms of maybe who has the right to use the home. Can it be rented, for example? If you have multiple kids and if there's any conflict that you can anticipate, sometimes this could help negate any of that conflict because it just maps things out for them. You could even set aside some funds for the ongoing maintenance within the trust. So, and then the other thing that a trust enables that is different than any of the other options we talk about is in the scenario of a disability or diminished capacity, a trust is a living document that still goes on. So the successor trustee could act on the real estate. So for example, if a home had to be sold to pay for long-term care, the trustee would be able to do that. Finally, I think if this is a little more complex and into estate planning, but if someone wanted to remove the property from their estate, they could consider what's called a qualified personal residence trust. This allows the owner to transfer the property out of their estate while maintaining the right to continue to live or use the home for a number of years. So it also gives them the benefit that you get to transfer the property at a lower amount of gift tax than an outright gift.
Right, Danielle, thank you. That's a lot to consider with that second home and certainly pros and cons for emotionally, also with trust. So thank you for that. Well, everybody, as I mentioned at the beginning of our show, we're going to take some live viewer questions today. So our producers have been behind the scene pulling a selection from the hundreds that have been coming in. So here we go. Mike, let's start with you. Should one consider adjustable rate mortgage or lock into 30-year? Go ahead.
Yeah, I think that question actually fits really nicely into the way that Danielle was talking earlier about the considerations you go through from a strategic finance standpoint. I think specifically for customers with the assets and means to be making a decision between financing a property and using cash to purchase, adjustable rate mortgages can fit in really nicely. I think if you're trying to optimize your borrowing, an adjustable rate mortgage generally will come with a lower introductory rate than the comparable 30-year fixed. So when I think about a 30-year fixed mortgage in that scenario, you know that your rate is going to be locked for the entire 30 years, but that insurance that you're paying for with that additional rate may not be needed. So for an example, with the adjustable rate mortgage, if you chose a 7-year ARM, that rate would be lower than the comparable 30-year, and it would be fixed for 7 years. So from a strategic finance standpoint, you would have savings every month for 7 years. And if you're working with a planner like Danielle, you could potentially set up a plan to pay off that mortgage over the 7-year period, or potentially the assets that you would have used for cash versus financing at the end of the 7-year period, you could pay off the note.
Thank you. Danielle, we got a question for you here. So how can you decide whether using a will or trust is the right choice for leaving your home to a child?
And this is a decision most of my clients are trying to make. So again, a will organize everything, but it doesn't give you the protection of a trust in that it is public record. It does have to go through the probate court, and that's going to take time and has some costs associated with it. It is usually cheaper to set up though, so there's a benefit for that. A trust, it's often used when your situation is maybe a little bit more complex because there are going to be costs to set it up and to update it. But a trust would map everything out for your successor trustee, which gives a lot of clarification. I feel like people use it more frequently in scenarios where maybe they have some conflict between, members of people that are going to be inheriting things. Second marriages or a blended family are a very commonplace that different assets want to be deployed to different, parts of the family members. I think if there's ever a child that's a minor, a trust is going to be a better option. Any child that's a special needs, or you have someone in the family that's going to inherit things that has a disability, for example, can be a great way to do it. And really, it just comes down to the complexity. The more assets you have, and the more states maybe you own property in, sometimes those are where trust is just going to make the most sense because of the level of complexity, and the trust just maps it out a little bit clearer, and it doesn't get those third-party administrators involved like the courts where a will would.
All right, Danielle, we have another trade-off question here for you. So is it better to use my cash to buy a second house or pay off my mortgage?
Okay, perfect. I think it comes down to your financial goals. Like we've talked about a little bit today, some people really want to go into retirement without a mortgage. So it might be a priority to pay down that mortgage, right? Rather than taking that cash to buy a second place. So buying a second place might mean you could go into retirement with a mortgage. I think you just have to focus on the financial plan and maybe run it all through some different scenarios to make sure that you have the assets to support both goals. And then some of it just comes down to preferences. There's going to be some math involved. What rate are you paying on your mortgage versus what rate would you, what are you getting on your cash? And would we have to pay a lot of taxes to free up your cash? So there's a lot of considerations in there. So I would say you probably just want to spend some time with your financial planner and map out some of these scenarios to kind of, see how different ways that you could approach this situation would impact your overall financial plan.
Awesome, Danielle. Thank you. Mike, we have a question for you. You got everyone a little excited about 1031 exchanges. So the question is, can you do a 1031 exchange of a rental property, rent out the new property for 2 or more years, and later turn it into a primary or secondary home?
Sure. So the short answer on that one is yes, but your intent from the start is what's important here. So if you do choose to use that, you would actually need to use the property as an investment property from the start and rent it out. But then you would need to follow along the same IRS guidelines that I talked about before for primary residence. So you could use the property for 2 years as a rental property and own it for 2 years, but then you would still have to use it as a primary residence after that to follow along the same IRS guidelines for the capital gains exclusion as a primary residence. So yes, but you want to make sure that you're following through with all the details and working with the tax professional to make sure it aligns with the guidelines.
Well, Mike, Danielle, thank you both so much for these great insights on this topic. Some key takeaways that I gathered from our discussion today. 1, think strategically about your borrowing. Whether you're paying in cash or taking a mortgage or bridge loan, you need to weigh interest rates, other investment opportunities, and risk. Secondly, manage the tax impact. If you're buying a home or passing property to your heirs, consider working with an estate planning attorney and tax professional. And thirdly, real estate impacts your overall financial plan. A financial professional can help determine how a home purchase or sale may impact your retirement savings and cash flow, and work with you to create a real estate strategy that aligns with your long-term goals. So, in closing, we hope you, our viewers, will join us for our next Insights Live webinar on March 12th, where we'll be discussing today's investment trends, including AI, crypto, and the bounce back in international stocks, and how all this may impact your portfolio and your plan. In the meantime, please reach out to your Fidelity representative to have your specific questions answered. And for more timely market updates and insights on other financial planning topics, subscribe to Insights from Fidelity Wealth Management for exclusive invitations to future wealth management webinars and access to our weekly newsletter. So thanks again for joining us.